Trading with patterns is an essential component of technical analysis. This means that you need to shift your focus on price action and what a pattern shows. All markets, regardless of type, have one thing in common. That is, they all consolidate in ranges, a lot. Therefore, one of the most common chart patterns are the triangles. The triangle pattern is a specific figure formed on the price chart, typically identified when the tops and the bottoms of the price action are moving toward each other like the sides of a triangle. When the upper and the lower level of a triangle interact, traders expect an eventual breakout from that area. As such, many breakout traders use triangle formations for identifying breakout entry points. There are different kinds of triangles that can be seen on a chart. In this video, we'll take a closer look at the ascending triangle pattern and the corresponding trade setups. Once you are equipped with this knowledge, you should be able to add a triangle trading strategy to your trade setup arsenal. The ascending triangle formation is a continuation pattern, and as the name suggests, it has the shape of a triangle. The ascending triangle is also known as the bullish triangle because it leads to a bullish breakout. This is how the ascending triangle looks like. The first element of this price pattern is an upward slope, followed by a flat top. This shows that the market has tried multiple times to break the resistance top, but it couldn't. Hence, we have developed a resistance line. The second element of the ascending triangle is a rising trend line moving upwards. This is what makes the pattern bullish. Now, all continuation patterns need to have a context of a trend. In the case of the bullish ascending triangle, we need to have a previous uptrend to support the breakout. Now that you learned how the ascending formation looks like, I want to share with you several important things that I've learned from trading with bullish triangles. First, on a price chart, the triangle pattern will rarely have a perfect shape. Oftentimes, you'll see an ascending wedge pattern which will break the resistance line, but will have no real momentum behind the breakout. Other times, the pattern will develop spiky bars that will lead to false breakouts. There is no perfect pattern. What's the first thing you see in this chart? That's right, the pattern is not perfect. I remember how I would read a book on a specific chart pattern, and when I would go into the market, I could never find an exact match. For example, in this chart, notice how the highs are not aligned perfectly. But notice how the price breaks through the upper trend line only to go higher. So don't search only for perfect triangles. Also, you really need to think in terms of what is going on behind the scenes. You don't just have to look at the price, but also try to read what the market participants are doing. When the price is moving up, it starts to develop the classical higher lows. For whatever the reasons, the buyers may become a little bit more aggressive with each new successive higher low. Or we can say that the sellers aren't too aggressive when the market turns down inside the ascending triangle chart pattern. Whichever alternative you prefer, that is what is causing the triangle price formation to develop. When we reach the climax point of the triangle, when the price has nowhere to go, that's the moment when you should anticipate a breakout. The location of the pattern is also important. If the triangle pattern is inside a big trading range, then the solid resistance level might not be that significant. If you pay attention at this chart, you'll notice the triangle pattern. But the problem is that it develops inside a big trading range. So even if there is a small breakout, the upward movement is restricted by this other resistance. However, if the ascending triangle price formation develops in the middle of a bullish trend, that would add more weight to the pattern. When the ascending triangle develops within a trend, then we're going to be interested in buying the breakout, like in this example. Regardless of their locations, during a trend, ascending triangles are bullish patterns that indicate accumulation. The higher lows in the pattern are a clue that buyers are not letting their positions go at a lower price, as the pattern makes higher lows. Another important tip is that you need to have a clear resistance level with a series of highs occurring at or near the same price. You don't want to have one or two peaks only, because it might be a swing high or a double top. There needs to be a number of clear attempts by the bulls that go nowhere with the price. Once the triangle breakout happens, you need to see a pickup in volume that will result in a nice long trade. The next thing you want to see in the breakout is for volume to accelerate on the move higher. This doesn't mean the volume on the breakout has to be the highest over the last 24 hours or something. It just means you need to see some acceleration to the upside. The key point is you want to see buyers participate in the move to increase the likelihood of follow through. So how to trade an ascending triangle pattern? The classic method is to buy the breakout once you have 3 or more touches with volume. Now, you have a few choices where to enter. The first option is to buy on the highest high after 3 or more tops. The potential issue with this approach is that the price could fall and is still either developing the ascending triangle or you are caught in a bull trap. The main problem with triangles and chart patterns in general is the potential for false breakouts. The price may move out of the pattern only to move back into it, or the price may even proceed to break out to the other side. A pattern may need to be redrawn several times as the price edges past the trend line but fails to generate any momentum in the breakout direction. What I prefer is to add the pivot points. I like to wait for a key pivot point resistance level to be breached and then place a buy order slightly above this level. The potential issue with this approach is that you are exposed to more risk as you are buying at higher levels with greater downside exposure. But this will eliminate a lot of false breakouts, which will occur a lot. That's why I like to add a safety net by using pivot points. So if you pay attention at this example, we have the upward trend line with higher lows, the clear resistance level, and the breakout. But in real time, as we don't know if the breakout is real or not, we wait for the price to consolidate above this pivot level as a confirmation of the breakout of the pattern. Once the price consolidated above, we can safely search for long entries. Here are other examples of ascending triangle breakouts with pivot point confirmation. Another approach is to buy inside of the triangle. Once you see the pattern setting up, you can wait for a touch of the upward trend line and then place a long entry. The benefits with this approach are that you can place a tighter stop since you are closer to the demand line, the support. This also gives you a potential profit before the actual breakout. The downside to this approach is you could wait a longer time for the move to the top of the triangle in a possible consolidation phase. This is a more advanced technique, and the most important thing is that you need to have a clear uptrend. When you spot an ascending triangle on the chart, you should be prepared to catch a bullish price move equal to at least the size of the triangle. A profit target can be estimated based on the height of the triangle added from the breakout price. The white line corresponds to the size of the triangle and its potential target, which is typically a 1-to-1 measured move. So the profit target for the setup is the distance of the triangle added to the top. Regarding stops, there are multiple areas where you can place your stop orders. First, you can place the stop order beneath the upward trend line. You can also use the low of the breakout candle. If the price is able to break out, you can place your stop beneath the low of the candlestick. This way, if the price reverses, you are not waiting until the uptrend line is breached. This way, you can keep more of your gains. Also, keep in mind, while ascending triangles provide a profit target, that target is just an estimate, a projection. A price may far exceed that target or fail to reach it. This is why using proper risk-reward ratios is mandatory. Otherwise, the risk is that the triangle pattern will transform into something else and will invalidate the reason you have entered in that particular trade in the first place. If you got any value from this and learned something new, don't forget to subscribe, hit the bell icon and leave us a like to show your support. Until next time.